How's it going, everyone? And welcome to Dividend Compounders with Cheese. These are the stocks to watch for the week of February the 19th. And by the way, Monday is going to be closed because of President's Day. I think this is going to be a very important week for the status check and the pulse of how retail is doing because we have giants like Walmart and Home Depot reporting, but also the commercial real estate industry because Realty Income is reporting, but alongside with Vici. So on Tuesday before the markets open, the first stock that I'm keeping on my radar is going to be Walmart. And Walmart recently announced that they're going to be doing a 3-for-1 stock split, which means for every share of Walmart that you have, it's going to be divided into 3. So to get the mathin', you're going to take this annual dividend that they pay out of $2.28 per share and divide that by 3. That means nothing really changes. You're still going to get the same amount of dividends. However, their dividend yield is going to go down, which means their dividend yield is going to be closer to a number such as like 0.45%. And Walmart is going to be really important to keep an eye on because depending on how they perform, it's going to have a domino effect on all of the other retailers like Costco, Target, and CPG products like General Mills, Kellogg's, Hormel, because Walmart has a huge influence on the US population. Whether or not you like them, it doesn't matter because 1 out of 3 Americans do their shopping at Walmart. And I can't predict the future. However, because inflation is still an annoying problem, I think the people are more inclined to shop at Walmart, who are known for their low, great value prices. So with that said, I'm predicting Walmart to either match or beat the earnings estimations. And moving right along, the next company on my radar is going to be Home Depot. It's not that I'm particularly interested in investing into Home Depot. However, it gives a pulse check and it gives us investors an indication of how the home building market is doing in the US. Because usually as more companies are building homes, they need contractors, and those contractors go to places like Lowe's and Home Depot in order to get their supplies. And on that note, can we just talk about what a dividend compounder with cheese Home Depot really is? Look at their dividend growth rate, 10%. The payout ratio is about 50%. The annual dividend payout is $8. The share per price is $361. This is an amazing company, and if you invest in Home Depot, I completely understand why. And let's move along to the next company reporting on Tuesday before the markets open, which is going to be Medtronic. I'm going to go ahead and assume that a lot of people are not familiar with Medtronic. They're basically in the medical devices industry. They manufacture and have patents and design and produce medical devices that people need in order to sustain life. So if somebody has a pacemaker, which is like a device that's inserted into your heart to help it run smoothly, there's a few companies that make stuff like that, right? One is going to be Johnson & Johnson, another one is going to be Edwards Life Sciences, and the third is going to be Medtronic. Medtronic not only makes cardiac devices, but they also make devices for people with diabetes, liver issues, kidney issues, anything related to the body. And this is a company that was really beaten up last year around October to November. However, since then they have recovered. But I am keeping them on my radar because if they miss their estimations and the stock goes on a dip, I am actually looking to get into this company because a lot of investors are really focused right now and have tunnel vision on AI. However, where my train of thought is going is that the average lifespan of a human is increasing by the day. The longevity of the human lifespan is just going up. It used to be like 65 and then it went up to like 72. It's only a matter of time when the human lifespan can live on average up to 100 years old. And when we get up into the 80s, into the 90s, our body starts failing, right? A lot of things start going wrong. And that's where I think companies like Medtronic are going to come in and help people to live the rest of their lives out for their bodies to function the way that it was designed. So this is a company that I think is essential and should be in the conversation with AI. And then as the markets close on Tuesday, there's a few companies that catch my attention, right? Number one is going to be Realty Income Corporation, which is one of the biggest and most popular dividend companies that's in the business of partnering with commercial real estate companies. And then there's Public Storage, which is, as the name implies, a storage company for people that have just way too much stuff in their house. And so they rent out a closet where they can put stuff like their old photo albums, furniture, things that are just bulky or that they don't want in their home anymore. However, what's funny is I made an entire video that was like 30 30 minutes long that I didn't bother editing because my conclusion on the storage industry is that it's overvalued. And I didn't want to spend 8 hours editing that video. So there's your little too long didn't read statement right there. Storage companies overvalued. There's better opportunities elsewhere. And then there's Toll Brothers. I don't know about you, but when I used to live on the East Coast, there were new houses, communities, and neighborhoods being brought up, it seemed like every other 3 months. And more often than not, they had a sign that showed like, hey, this community is being built by XYZ. And that company was Toll Brothers. Toll Brothers is in the business of making, constructing, and building houses. However, in my personal opinion, I think this is a way too cyclical industry where I just do not want to get involved. So with that said, on Tuesday, the company that I'm really going to be laser focused on is Realty Income Corporation. Not only do I have a sizable portion of it in my portfolio, Realty Income has been beaten up throughout the year. If we look at their 52-week performance, they used to trade at about $65 a share. However, as the interest rates just stay stubborn, and with the most recent report saying, hey, inflation is actually not slowing down, it's staying flat, the investors are baking in that Realty Income is going to be struggling because Realty Income actually does better when interest rates are lower. That way, their clients have a better time and have the means to pay their rent. So the investors are already pricing in that Realty Income is going to be struggling until the interest rates come back down. But with that said, just look at their dividend profile. Their dividend yield is just shy of 6%, a monthly dividend, and their payout ratio is 77%. They grow their dividend at a rate of about 3.7%, which is about the same as the rate of inflation when things are normal. If there is a massive sell-off and they go into the range of $46 or $47, I'm going to be throwing a lot in. But please do your own due diligence and research to figure out if you like Realty Income Corporation. And then the next day on Wednesday, there's only two companies that catch my eye. Number one is going to be Medicals Properties Trust, ticker symbol MPW, that is in the business of providing real estate properties to hospitals, clinics, medical centers. Me personally, I am not interested. However, there is a dividend compounder with cheese that is just way too expensive, but I want to mention and talk about, and that's going to be Wingstop, ticker symbol Wing. Just look at the 5-year performance of Wingstop. If you had bought into it back in 2019 for $69 a share, 69, that's very nice. Look at the progression of how they performed over the years. Remember, Wingstop is a fast casual restaurant that serves chicken wings. I am not making this up. This is not a tech company. Look at their rate of return throughout the years. If you had just bought it and held on, you would have had a 341% rate of return. A 341% rate of return. Their dividend yield is 0.28%, so I doubt anybody is going to be interested in them for the dividend. However, this is why I am so bullish on food companies like Domino's or Texas Roadhouse and even Chipotle, which I believe that Chipotle is eventually going to have a stock split because their stock price is ridiculous, right? I think the logical thing for them to do is eventually in the next 5 years to do like a 5-for-1 stock split and then to implement a dividend. And when they do, I'll probably consider jumping in. And that's why you can find success in the stock market anywhere. It does not have to just be tech stocks like Microsoft, Nvidia, and Apple. And when the markets close on Wednesday, there's one company that everybody in the stock market is going to be paying attention to because they are responsible for the buzz and the hype behind AI, artificial intelligence. And that's going to be Nvidia. Other big names that are going to be reporting after the bell rings, such as Rivian, the EV car producer. There's Etsy, which is kind of like the hipster version of eBay. There's Lucid, another EV car producer. And then there's Dutch Bros, which is a company that kind of made Starbucks nervous for a hot second, but then the general public realized Starbucks is GOAT, so they all started flocking back to Starbucks. Nvidia is one of those companies where I actually jumped in back in 2019, and I actually sold somewhere in 2021 or 2022, and I'm not going to lie to you, I kind of regret selling it because at the time, my investment in them went up by price so much that I thought it was a good time and a good opportunity for me to take some of my gains. However, had I just held on a little bit longer, my investment in Nvidia would have grown even further and even more. However, that's just one of those things where you have to accept what happened, and you should never regret when you actually capitalize on taking some gains, unless it's one of those situations where you're happy with getting a 3% gain, whereas if you just held on for one more year, you could have got a 300% gain, then yeah, I can see why you would be kicking yourself in the shin. At least you got out in the green. Their 52-week range, $204 during their low. Since then, they have just been on a roar. Just look at this. They're trading for $726 a share. Their dividend yield is hilarious. It's 0.02%, and the annual dividend payout is 16 pennies. 16 pennies, and they actually don't grow their dividend. They've been paying the same amount year after year for the past few years, and the payout ratio is 2%. I've never in my life have seen a dividend profile where the company pays a 2% payout ratio. It almost feels like this is the dividend yield, right? For me, I think Nvidia is a little overvalued right now, and the momentum on AI is just too much. So I'm personally not going to put Nvidia onto my radar. However, I know Wall Street and other investors are going to be watching them. It kind of reminds me of the roller coaster ride with Tesla stock. I remember when Tesla, whenever they reported on their earnings, sometimes it could go up 20 to 40% on a single trading day. And that was during the pandemic when there was so much hype surrounding the EV market and all gas combustible cars being obsolete and everyone's going to be driving an EV in the next year or so. I am so relieved that momentum has died down, because to truly transition to an EV future, it's going to take decades. I'm guessing another 15 to 20 years before it's actually doable. And this is coming from a guy who sold his car and rides a bicycle everywhere. By choice, by the way. I did not get a DUI, I promise. I do it for my health. And then on Thursday, we do have a lot of big names reporting. The first one is going to be Moderna, which is a biopharmaceutical company. And then we have Dominion Energy, which is a utility that I am actually invested in. And I will be honest, I made a video about them, but I am not bullish on Dominion. I just think it's one of those safer companies that just pays a dividend, right? It's a utility. Everybody is going to be utilizing their air conditioner during the summers, their heaters during the winters, and utility bills is something that people just pay every single month. I'm sure out of a customer base of 100 people, 98 of them pay their bills on time. And then there's Keurig Dr. Pepper, which I'm personally invested in over Coca-Cola because I see a brighter future with the Keurig coffee machines, especially if you make a trip to Costco. Their coffee section is almost entirely full of the Keurig pods. And even if it's off-brand and it doesn't say Keurig per se, they are still paying royalty fees for producing coffee pods and to be compatible with their machines. And then there's Fiverr, which is a platform where independent contractors can advertise their businesses and services. I know, it kind of sounds like this video is sponsored by them, but it's not. And then there's Wayfair, which is an e-commerce furniture company. And I'll be honest with you, when it comes to furniture, I just feel like that's one of those purchases where it's better made in person. Going in person to IKEA to sit on the couch that you're thinking about dropping $2,000 on. But I understand if you live in the middle of nowhere in West Virginia and Amazon is all you have, of course you're going to order a couch off of Amazon. I think it's just too much of a risk to order a chair or a dining table or a couch off of an e-commerce website. That's just my personal take. And when we look at KDP, they actually hit their 52-week low back in October and November of last year when it was trading for about $27 to $28 a share. And since then, they have recovered a little bit, but they are still in the red from their 52-week high of $36 because right now they're trading for $31 a share. The dividend yield is not juicy, I understand. However, it's the dividend growth and the payout ratio that compelled me to jump in. But alongside with their future, I think it's going to be bright. I could be wrong, but that's just how I feel. And then as the markets close on Thursday, there's a lot of companies that I'm personally kind of interested in and will be keeping an eye on. And interested not in the sense of that I want to invest in them, but because I'm genuinely curious about the health of their business. And the first one is going to be Square. I guess they call themselves Block now. It's the company that's responsible for payment processing, and a lot of independent retailers use Block to process card payments. So if you've ever been to Portland, there's a lot of food trucks all throughout the city. And more often than not, 9 out of 10 of those merchants, they actually utilize Block to process your card payments. So I think this is a company that's a little future forward in comparison to Visa or MasterCard. And the next company is going to be Carvana. Now, I don't exactly love this business model. However, I have used their services in the past, and it made the car experience so much better. Because one of the things that I do not enjoy as an adult is when you have to go buy another car, because I dread the idea of having to deal with car salesmen and saying, hey, let me just talk to my finance manager. And I just don't like the idea of negotiating and haggling with the folks in the car showroom. It just bothers me. So Carvana, I'm kind of thankful for, but it's a business model that I just feel like is hard to be profitable in, especially when you take into consideration their inventory issues, right? I feel like back in 2021, when there was a shortage of cars available due to the chips shortage and the supply chain issues, Carvana is one of those companies that decided to just buy out every single used car from auctions and from people that they could in order to inflate their inventory. That way they can charge whatever they want. However, what has happened since then is that the supply chain issues have resolved themselves, and now there's an abundant supply of cars back on the market. As a business-oriented individual, I just feel like Carvana is about to lose a lot of money on the cars that they paid a lot for 2 to 3 years ago. Like, say they bought a Ford F-150 for $60,000 and they paid 20 grand over the market price, and that was back in 2021. Today, they're probably going to have to sell that exact same truck for about 31 grand. And when you multiply that on a larger scale, just imagine the amount of losses they're about to incur. And then after that, there is going to be Intuit. Intuit is a tax software company that I just don't agree with, right? My personal feelings aside, it's a fantastic business model. But with my personal feelings, I hate the fact that there's companies that are predatory when it comes to taxes. Whereas every other country in the world, filing your taxes is free and it's already done up front. Whereas all you have to do at the end of the year is just confirm and sign off that the taxes owed and paid are the correct amount. Whereas in this country that we live in, for most people, we have to pay in order to file our own taxes. And there's companies like Intuit that take advantage of the system in place. And then they pay off their lobbyists in DC in order to make sure that this model does not disappear. Because I know there has been some movement to make filing taxes free for everyone. However, companies like Intuit will always make sure that that will never happen. So I personally hate them. But on a business side, I think this is intelligent and this is phenomenal. So let's move on to the next company, which is going to be Rocket. Ticker symbol RKT is in the business of mortgage loan originations and handing out personal mortgage loans to people. They like to label themselves as a tech company, but they're not. They are a mortgage company, and I am not bullish on them because even though I qualify for the VA loan, which gives pretty good rates on the mortgage, right now, if you pause this video, open up a new tab and look at the average mortgage loan rates happening in this country, it is so high. I cannot imagine people buying houses right now as they did back in 2021. So without doing my research and making an ignorant statement, I just feel like the housing market right now is probably going to suffer until the interest rates come back down to earth. And then last but not least, on Thursday after the bell rings is going to be Vici. I already made a video about them, so if you want to know my opinion and my recommendation, go ahead and watch that video. However, right now, Vici is trading for about $29 a share, and their dividend growth rate is actually pretty nice at 10.7%. Their dividend yield is 5.6%, and their payout ratio is just shy of 78%. And then on Friday, there's not much happening. However, there is a media conglomerate giant, Warner Bros. Discovery, and this company is responsible for producing major feature films, documentaries, TV shows, you name it. If it's consumable, they make it. And then for the rest of the companies on Friday, I am not interested. However, there is one that I'm kind of keeping an eye on, and that's going to be Bloomin' Brands. Now, Bloomin' Brands is in the restaurant category. Unlike Domino's, Texas Roadhouse, or Wingstop, I'm not bullish on Bloomin' Brands. This is their portfolio of restaurants. They have Outback Steakhouse, which is actually pretty good. They have Carrabba's Italian Grill, which is terrible. No flavor in any of their dishes. Number 3 is Bonefish Grill, which is really funny because 25 years ago, we used to go there for homecoming performing in high school, which is hilarious to look back on. And then they also have Fleming's Prime Steakhouse and Wine Bar. And as a consumer, I just don't eat out at those restaurants. I'm just not particularly interested in that company. With that said, look at their dividend profile. It's actually looking pretty good. Their dividend growth rate is 71%. That's not the payout ratio. That's how much they're growing their dividend payout year over year. Their payout ratio is just shy of 36%. Their dividend yield is 3.5%. However, if you look at their 52-week range, their high was $28, their low is $22, and they're currently trading for about $26, which tells me that they're pretty much in line with their expectations from Wall Street because their price target is $27 and they're trading just shy of that, minus 18 cents. So whether Bloomin' Brands does good or bad on Friday, I'm not interested. Anyways, those are the stocks that I have on my radar for this upcoming earnings week. I hope you have a good rest of your day. This is Dividend Compounders with Cheese signing off. Stay safe.